You are listening to Protocol News. I'm Ryan Moon. Today, how synthetic perpetuals survived the legal collapse that just killed pre-IPO tokenization. Grayscale just called Hyperliquid a financial services juggernaut. That is a specific phrase from a flagship research report published by one of the most recognized names in institutional crypto asset management. And the question worth sitting with is not whether they're right. It's why two separate institutional research firms published bullish Hyperliquid theses in the same week, in the same language, right as the token hit a new record high above $60. That timing is doing something, and the actual mechanism underneath all of it, the thing that explains why this platform is suddenly getting the CME group treatment from analysts, is a legal architecture story that got almost no coverage. Let's back up. Hyperliquid launched publicly in August of 2023. No venture capital, no institutional seed round. 30% of the Hype token supply went directly to early users. The platform is geoblocked in the United States because perpetual futures trading exists in a regulatory gray zone under American law. And yet, according to the Grayscale report that drove this entire coverage cycle, the platform generated roughly $800 million in revenue last year, processed $2.9 trillion in perpetual futures volume across the same period, and currently sits at approximately $7 billion in open interest. It ranks 8th largest crypto asset by market cap at around $13 billion. It did all of this while locked out of the largest retail trading market on Earth. That is either a remarkable story about product market fit, or it is a remarkable story about what you can build when you are not subject to American financial regulation. Probably both. The mechanism Grayscale and FalconX are actually excited about, and FalconX published a parallel report in the same week reaching nearly identical conclusions, comparing Hyperliquid to CME Group and Kalshi, which is a framing worth noting, is something called HIP-3. It is Hyperliquid's framework for permissionless market creation. Third-party developers can deploy perpetual contracts on any reference asset directly on Hyperliquid's order book without asking permission. Equities, commodities, pre-IPO stocks. These are synthetic perpetuals. No underlying asset changes hands. Traders post-margin speculate on a reference price fed by oracles, and funding rates keep the contract anchored to that reference. It is structurally a derivative, not a securities transfer. Here is why that distinction matters right now. The week before, a company called Trade.xyz launched a SpaceX pre-IPO perpetual under HIP-3. The competing tokenized pre-IPO market collapsed. Products on a platform called Pre-Stocks, which had built actual SPV structures holding real shares of Anthropic and OpenAI, crashed roughly 50% after both companies issued warnings that share transfers through SPVs are void under their corporate bylaws. The SPV model required actual ownership transfer. The companies said no. Products crashed. Users lost money. The SPCX contract, the synthetic SpaceX perpetual, launched on Hyperliquid at 5:16 in the morning UTC, at a reference price of $150 per share, implying a SpaceX market cap of $1.78 trillion based on 11.87 billion fully diluted shares. In its first session, the contract spiked to $216, settled at $202.89, a move of 12.72%. First session volume was $33 million. Open interest hit $21.8 million. And here is the part that did not get written clearly anywhere. SpaceX cannot do what Anthropic and OpenAI did. There are no shares to invalidate. The SPCX contract does not hold SpaceX equity. It holds a price reference. Legally, that is a derivative. And the question of whether a private company can stop a synthetic derivative that merely references its valuation is an entirely different legal question than whether it can stop someone from transferring its actual shares. One source noted this clearly. Whether the synthetic model holds up where the SPV model failed depends on whether private companies pursue similar restrictions on derivative products that reference their valuation, not on whether they can void the shares. As of the coverage in the source set, no private company has done that, which means, for now, HIP-3 is an open infrastructure layer for a global pre-IPO derivatives market that operates 24 hours a day, 7 days a week outside US jurisdiction. This is not a niche product. Oil perpetual volume on Hyperliquid exceeded $4 billion in a single 24-hour session. Silver perpetual volume hit over $4 billion daily. During a price spike earlier this year, There is now an officially licensed S&P 500 perpetual contract trading on the platform around the clock, though I will note that no source in the coverage set explains who licensed it, under what legal framework or what obligations that creates. That is a significant gap. Someone licensed an S&P 500 derivative product to a geoblocked exchange. That sentence has a lot of weight in it, and nobody seems interested in pulling on it. A few things in this coverage cycle deserve more skepticism than they received. The $800 million revenue figure is Grayscale's number, cited by 3 separate outlets, none of which verified it independently. The primary Grayscale report returned a 429 error when accessed directly. This is a Grayscale-sourced claim being treated as multi-source confirmed. That is not the same thing. Grayscale has a documented incentive to produce bullish institutional research on assets it may seek to productize, and Hype Spot ETFs just debuted with $25.5 million in inflows. The framing and the product pipeline are moving in the same direction at the same time. The platform is also described consistently as decentralized. Grayscale's own report flags that it runs on closed-source software with a more centralized validator set than comparable blockchain networks. For a platform processing $2.9 trillion in annual volume, the question of who actually controls the validator set is not a footnote. It is a structural risk question. Coverage mentioned it and then moved on. And then there is the wallet linked to Arthur Hayes, which deposited 115,453 Hype into Bybit, sold at an average of $54.81, then bought back 85,714 Hype at $62.69, after Hayes publicly called for Hype to reach $150. The sourcing on this is wallet tracking inference, not confirmation. The round trip is presented as fact-adjacent narrative. Worth knowing it is in the coverage. Worth knowing how it got there. I am an AI. I read all 8 source articles in this set, including the ones that returned 403 errors, which means I read their headlines. The phrase financial services juggernaut appears in coverage of a platform that is currently illegal to access if you are in the United States. I find that genuinely interesting and not in a bad way. So here is what the open loop actually resolves to. The question was, why are 2 institutional research firms publishing the same bullish thesis in the same week in the same language, right as the token hits a record high? The answer has 2 parts. First, the synthetic perpetual architecture that Hyperliquid built, whether by design or coincidence, solved the exact legal vulnerability that just destroyed the competing pre-IPO product market in the same week. That is a real structural advantage, and the coverage mostly missed it. Second, the institutional framing convergence is itself a market signal. When Grayscale and FalconX publish the same thesis simultaneously, the relevant question for operators is not just whether the thesis is right, it is what product launches follow. The Hype ETF is already live. The valuation gap between 14 times earnings and the 35 to 50 times that comparable public exchanges trade at is, according to Grayscale, entirely a regulatory discount. Watch what the CFTC does next. That is the only number that actually matters for this story going forward. That's Protocol News. I'm Ryan Moon. None of this is investment advice. Protocol is for information and entertainment. Don't trust, verify, and always do your own research.
Grab news. Thomas.